Kautilya. Today we will deal with the topic Goods and Services Tax, which is part of the economy syllabus, Indian economy, as part of our Group 1 screening test. Okay, so whenever we look at a topic, especially in the preliminary or screening examination, we should try to focus on the concepts. You should have conceptual clarity. Only when you have the conceptual clarity can you answer the questions in a better way, because questions in the examination will not be directly from the books that you read. By reading these books and the material that which we provide, you will get a broad understanding, but the examiner will try to twist the questions and give you in the exam. So that is why you have to build up on the basic concepts. So once you're clear with the concepts, once you have the conceptual clarity, you will be in a position to answer any kinds of questions which are asked in the competitive examinations. In the same way, this topic of goods and services tax is there in the preliminary examination syllabus as well as the mains examination syllabus. But in prelims, we'll try to focus more on the framework, the structural framework of the goods and services tax, the various kinds of concepts involved in the taxation system, the indirect taxes, the direct taxes, the classification, and how GST is going to be implemented, what are the various provisions which make up the goods and services tax in India. But when it comes to the mains, the orientation will be more of analytical, and it will be a broad understanding. Rather than focusing on facts, it would be more analysis based. So let us begin with this topic. So why is this in news? The Goods and Services Tax Bill, that is the 122nd Constitutional Amendment Bill. Okay, the Constitutional Amendment Bill 122 is related to the goods and services tax to be introduced in India. This bill has been passed in the Lok Sabha and Rajya Sabha, and it is soon to become a act after it receives the presidential assent. So you can expect a question in your preliminary examination if from this very first sentence that you're seeing. They might ask you, they might give you various options. GST bill has been introduced as part of 122, 121, 131 and 132 Constitutional Amendment Act. So now that you know the answer, it is the 122nd Constitutional Amendment Act by which the goods and services tax has been introduced. Okay, while I am making you aware of these kinds of questions, you can just note it down in your rough notebook or your class notebook, so that while you revise these topics before the examination, you will be in a very good position to answer any kind of questions that come on this specific topic. Here in the classroom itself, we are providing you the material which is necessary to answer the questions in the examination. Apart from that, whatever I discuss in the class, the questions which I give, please try to make a brief note on those lines in your notebooks. So why GST? Okay, what is GST? In a very crude terms, it heralds the first significant step towards indirect tax reform in India. So this basically, GST deals with indirect taxes reform. Okay, it is a holistic reform which deals with which is going to subsume all the indirect taxes which exist in India into a single tax. Okay, single tax for one nation, one tax. That is the philosophy of GST. See, in the heading itself, you can see it is one nation, one tax. GST is premised on this concept of one nation, one tax, so that India can be established as a unified market. Okay, and then first let us look into some basic concepts. What are you have two types of taxes in India. Broadly speaking, the two types of taxes which are classified according to the Government of India are the direct taxes and the indirect taxes. This is the broad classification, because within these two broad classifications, you have different kinds of sub classifications of taxes. Okay, now let us look into direct taxes. What exactly are direct taxes? Direct taxes, as the name suggests, are the taxes that are directly paid to the government by the taxpayer. Here you see, you pay your personal income tax. Okay, the personal income tax, as a citizen of this country, you are directly paying to the government of India or the tax department. In the same way, the corporate tax, okay, the security transaction tax, the banking cash transaction tax, these are kinds of direct taxes, some of the examples of direct taxes which are also being visible on your screen, okay, which are paid directly to the government or the tax administration system. It is a tax applied on individuals and organizations directly by the government. That is, there is no via media, you don't have any middlemen or some middle level organizations. The tax is directly paid by the citizens or the organizations to the government. Okay, that is about direct taxes. So just keep it in mind. You should have this broad understanding. What are the different kinds of direct taxes in India? What are the different kinds of indirect taxes in India? So that you can actually understand why are we getting the goods and services tax and how is it going to help in the economic development of India. And then you have indirect taxes. What are indirect taxes? Indirect taxes are nothing but the taxes which are imposed by the government of India, but the taxpayers pay the tax to the government or the tax administration in an indirect manner, okay, via a media. For example, you go to the shop, okay, you go to some shop and purchase a television, okay, but you are purchasing this television for say 10,000 rupees, okay, all right. Here you are directly giving the shopkeeper 10,000 rupees. You are not paying any tax separately to the shopkeeper, but within this 10,000 rupees the shopkeeper might have to pay a tax of 10%. I'm just giving a hypothetical example over here. The shopkeeper might have to pay a tax of 10% as an excise duty or the sales tax, okay. So this 10%, this 100 rupees, which amounts to 100 rupees, this is paid by the shopkeeper to the government or the tax administration. So now you can understand, right? That is why these are called as indirect taxes. Directly you're not paying, but indirectly the shopkeeper or the various kind of private organizations, they pay the tax to the government on your behalf, okay. So the different kinds of direct taxes which exist in India are the customs duties, the excise duties, the service tax, and the sales tax or value added tax, okay. Customs duties, as you know, these are levied on imports and exports. For example, if India is importing some goods like petroleum oil and it is exporting some goods like gems, jewelry, electronic products, so the government of India levies this customs duty on the merchants, okay. That is what is customs duty about. Excise duties are levied by the government of India for the products manufactured in India. For example, you have BPL company in India. It manufactures televisions. So once this company manufactures televisions and it is selling those products, excise duty is levied on the company, which is paid to the government. And service tax. For example, you are availing some services, such as you go to the hotel or a restaurant and you eat food. After you eat the food, you get the bill. In the bill, you'll be seeing that there is mention of the service tax. So this is an indirect tax that you are not directly paying, but you are paying you pay the total amount to the merchant or the restaurant owner, who will pay the tax to the government. In the same way, you have sales tax also and the value addition tax. So there's some brief information regarding the customs indirect taxation in India. Of these various kinds of indirect taxes which we've seen above, like the customs duties, excise duties, service taxes and sales taxes, etc., until the beginning of World War II, customs duties had remained the most important source of revenue. But now, excise duties have emerged as the biggest source of revenue. Under the Constitution of India, the central government has exclusive power. Please remember this. You can have a question over here. Under the Constitution of India, the central government or the union government, okay, has exclusive power to levy customs duties and excise duties on commodities other than alcoholic liquors and narcotics. On alcoholic liquors and narcotics, even the state governments can levy excise duties and customs duties. Okay. So, a brief understanding about customs duties. While using its constitutional powers, the central government now levies customs duties on both imports and exports to India, which I have already told you. Let's have a look at excise duties. An excise duty in a true sense is a commodity tax because it is levied on production and has absolutely no connection with its actual sale. As I already told you, if there is a company called BPL, okay, which is producing TVs, so the government of India, what it does is it levies an excise duty on the production, irrespective of whether the company has sold the TV or not. When it is selling, when the TVs are sold in the market, then sales tax is collected. Before that, as soon as the production is made, the government collects excise duty. Okay, it is levied on commodities, production of commodities in India. In the same way, like central excise duties, you also have state excise duties in India. The states have exclusive jurisdiction. You can also, please be alert. When I put this question mark, you have to try to note this kind of information. Okay. So the state governments have exclusive jurisdiction. When I say exclusive, it means that the central government doesn't have jurisdiction over excise duties on alcohol and narcotics. It is an easy source of revenue, and possible revenue proceeds from this source are high. Okay, as you know, alcohol consumption is pretty high in India, especially in states like Telangana, Andhra Pradesh, etc. So that is why the state governments earn a good amount of revenue. Service tax. Service tax was introduced in the year 1994 on 3 services in India. So you can expect a question, when was service tax introduced in India? The examiner will give you 4 options, and among them the year 1994 to 95 is the right option which you have to choose in your objective examination. So when the service tax was introduced first in India in the year 1994-95, it was introduced on 3 kinds of services. Those are the telephone services, the general insurance, and share broking. Okay, you know what is general insurance? You have life insurance and general insurance. General insurance deals with any kinds of insurance apart from life, such as property insurance, okay, car insurance, etc. All these kind of things come under general insurance. Since then, every year the imposition of service tax has been increasing. That is, the tax net has been widening in India. As a result, the number of assessees has increased considerably over the years, and so has been the revenue from this tax. That is, the tax net has been widening, as well as automatically the revenue that it is generating, that the government is generating, has also been increasing. Okay. Now let us come into what is GST. So this brief understanding about the direct taxes, indirect taxes has been given to you so that you can have now understand in a better way why we are getting in GST. Why does India needs a single unified goods and services tax in India? Okay, right. So what is GST? It is a tax levied when a consumer buys a good or a service. That is, it is levied for both goods as well as services. Okay, have this kind of basic understanding. Okay, It is meant to be a single, each word in this definition is very important. It has a meaning of its own. Comprehensive tax that will subsume all the other smaller indirect taxes on consumption. Okay, so the basic thing about GST is, it is, see, please be alert, there can be a question over here. The basic understanding of GST is that it is going to subsume all the major and minor indirect taxes, not direct taxes. In GST we are dealing only with indirect taxes. Why are we trying to get in a single unified indirect tax and all that, you'll understand subsequently, which I'll be explaining. But now just try to analyze that GST is a single comprehensive tax that will subsume all other indirect taxes like the service taxes, the excise duties, okay, so that India can be a unified market. It is a single tax on the supply of goods and services right from the manufacturer to the end consumer. It is a unified single tax. There are no multiple taxes. In India presently you have multiple taxes at each stage, okay. First, a product is produced in a factory, from there it goes to the wholesaler, and from there it comes to the retailer, and then to your normal MRP shops that you purchase from. So while it is passing through all these stages, various kinds of taxes are levied at each stage. This is going to increase the final price of the goods purchased by the consumers like you and me. So this is having a cascading effect, okay. GST will try to minimize this cascading effect because it is a single tax which is right from the manufacturer to the consumer, till right from when the good or service was produced in the factory or the manufacturing unit till the time it reaches the consumer. There is only one kind of indirect tax levied on the product. That is why GST is going to be a game changer in Indian economy. So this is how GST is not something that is novel only to India. This has already been implemented in most of the developed countries, okay. Till now almost like 160 countries across the globe have already implemented this system of taxation. Also, GST does not tax or get into the specific commodities, okay. It is based on this concept of VAT, that is value added taxation, not specific kind of taxation, okay. So what is the mechanism of GST? On your screen you can see the infograph which is going to explain you the mechanism of GST and how does the GST regime work. Because if you do not have this kind of understanding and you just try to mug up things, you might not be able to remember, you might not be able to recollect the concepts in the examination, and you might get confused in the examination and you might answer the question in a wrong manner. But if you have this conceptual clarity, you will be in a position to answer any kind of questions. So you see, any kind of good which is produced, it is manufactured in a manufacturing unit, and then it goes to the wholesaler, and then it is going to the retailer. So what is happening? Okay, I have tried to explain what exactly is GST through this example, okay. How at various stages taxation is levied on indirect taxes are levied in India, and in which way GST will be helpful to overcome the present difficulties, okay. So now let's consider a manufacturer of gears. In a factory, gears are being produced, gears which are used in gears which are used in automobiles like cars or motorbikes, etc. A company like TVS is producing gears, okay. Let's say the manufacturer buys a raw material worth rupees 100, okay. this is just a hypothetical example for you to understand what exactly is GST going to make the difference with. Okay, so within this 100 rupees there includes a tax of 10 rupees. So the actual price of the raw material is 90 rupees. Okay, and this 10 rupees is the tax. So on the whole, this owner of the factory is paying 100 rupees. Okay, in the process of creating the gear, the manufacturer adds value to the raw materials. See, raw materials are just nothing but brick and mortar kind of things. You cannot put to use. Okay, so he's going to going to gather all the raw materials like steel, etc., steel, iron, etc., and he's going to make a gear, proper gear. Okay, so obviously he's added some value. The raw material like steel and all has been transformed into a gear which can be used in cars and motorbikes, etc. So he has added value to it. Value has been added in. Okay, value to it. So let us take that the value added by him is rupees 30. Okay, so now the gross value of his good would be rupees 100. 100 rupees is spent on getting the raw materials. 30 rupees is the various kinds of value that he added. See, obviously when he is trying to produce a gear, he is going to put in labor, capital, technology, and every kind of innovation to make this gear. So obviously he is going to use another 30 rupees. Okay, so totally finally this product's value is rupees 130. Okay, now let us see what is happening. Now if a tax of 10% is levied, okay, the tax on the output will be rupees 30. Okay, this is the tax on the output. Before GST, this is the tax that is levied. 10% of 130 rupees is 13 rupees. But under goods and services tax, what happens is the person, the manufacturer, can set off his tax, that is rupees 13, against the tax he has already paid on raw materials or inputs, that is rupees 10. This set off is also called as the input credit. Okay, this forms the crux of goods and services tax. That is why we are going to get the goods and services tax. Therefore, the effective GST incidence on the manufacturer is only rupees 3. I hope now you can understand. First he got it for 100 rupees. In this 100 rupees, the 90 rupees product, 93 rupees is for the product, 10 rupees is the tax. This tax he has already paid on the raw materials, right? But if there is no goods and services tax, what is happening is he has added a value of 30 rupees, right? So the value of the product is 130. So if a tax of 10% is levied on this also, this 130 rupees, it is going to amount to 13 rupees. So here you can see the cascading effect. This person has already paid a tax of 10 rupees over here on the raw materials, and again as an excise duty, as an indirect tax, he is paying 13 rupees. So 10 plus 13, he is paying a total of 23 rupees. Okay, this is the cascading effect. But what is GST trying to do is, it is going to remove this cascading effect, as he has already paid this 10 rupees. Okay, this 10 rupees is put aside. Now his value addition is 30 rupees is the value addition, right? So he is going to pay a tax of 10% only on this 30 rupees. How much is 10% of 30 rupees? It is 3 rupees. So this 3 rupees is the additional tax that he is going to pay, that is going to be evaluated. So finally the input credit that he gets is 13 minus 10 rupees, that is he only 3 rupees is the GST incidence on the manufacturer. Okay, first is 10 rupees, then 3 rupees, so he's just going to pay 13 rupees in total instead of 23 rupees. So you see, instead of 23 rupees he is going to pay only 13 rupees as a tax holistically and GST of only 3 rupees. So that is how GST will help the manufacturer of the product. So automatically, when the product manufacturer is going to pay lesser taxes, okay, he is not going to undergo the cascading effect. The final product which comes into the market, the consumers can buy it at a lesser price, and that is why it will benefit the economic development also. It will benefit the people also. So what is this input credit or set off? Input credit is an aggregate total amount of tax paid by a registered dealer on the total purchases made by him within the state from other dealers. Okay, it is a self-explanatory thing. Salient features of input tax credit: it can be adjusted against the tax payable by the purchasing dealer on his sales. As we already saw just a while ago in that slide, how the effective GST incidence on the manufacturer is only ₹3. Okay, the input credit can be seen over here. Okay, the 10 rupees is seen as an input credit. This is the set off, is also called as input credit. So this input credit is allowed for both manufacturers as well as traders under the GST regime. So in the same way, at the next stage, what is happening? The next stage is that the good is passing from the manufacturer to the wholesaler. The wholesaler purchases it for ₹130 and adds on value, which is basically his margin. Okay, wholesaler, when he's buying this product from the manufacturer for ₹130, but when he sells again to when he is going to sell this product to the retailer, he wants to make profit. Obviously, anybody wants to make profit, so he's adding some value to the product, such as, for example, 20 rupees is a value that is being added by the wholesaler. He's going to, the gross value of the good will be, of the gearbox or gears, will be ₹150 by the time the wholesaler sells it. Now on this, a 10% tax is, if it is levied, it will be ₹15. Under GST, what he can do is, he can set off the tax on this output, ₹15, against the tax on his purchase good from the manufacturer, that is ₹13. Okay, so the manufacturer has paid a tax of ₹13. Thus the effective GST incidence on the wholesaler is only ₹2. 15 minus 13, that is ₹2. Okay, see, when he is buying this product for ₹130, in this ₹130, 13 rupees is the tax paid by the manufacturer, indirect tax paid by the manufacturer. This is included in this ₹130. Okay, so if you see, the wholesaler has already paid 13 rupees indirectly, and now GST is calculated only on the remaining amount. That is why it is only ₹2. GST incidence on the wholesaler is only ₹2, because he is making a profit of only 20 rupees. Holistically, if you see, relatively, he has made a profit of only 20 rupees. ₹130 is what he is purchased it for. He is selling it for ₹150. He has made a profit of only 20 rupees. So tax is levied only on this 20 rupees instead of this ₹150, because within this ₹150, this ₹130, he has paid 13 rupees already. So that is how GST is going to help the wholesaler also. So let's come to the next stage. In the third and the final stage, a retailer buys the gear from the wholesaler to his purchase price of ₹150. Retailer is going to give ₹150 to the wholesaler, and he is going to purchase the gear. Okay, he adds value, say ₹10. Okay, a value of 10 rupees is added, because he also has to make some profit, so he is going to sell it for ₹160. Okay, so the gross value of the product now is ₹160. So you see, the raw material was purchased for 100 rupees, and now by the time it has entered the retail shop, it has become 160 rupees. Okay, so if you calculate it at 10% tax, it is going to be ₹16. But under GST, what happens is the retailer can set off his tax of rupees 16 against the tax on his purchase from the wholesaler, that is rupees 15. So the retailer brings down the effective GST incidence on himself to rupees 1, that is 16 rupees minus 15 rupees, that is he is going to pay a tax of only rupees 1. That is why GST is reducing the cascading effect. Okay, thus the total GST on the entire value chain from the raw material or input suppliers through the manufacturer, wholesaler and retailer, finally when it is coming to the consumer, is only rupees 16. Okay, the consumer is paying an effective tax of only 16 rupees. Earlier it was how much? First 10 rupees is being paid, and then again 13 rupees was to be paid, and then again 15 rupees was to be paid, and then again 16 rupees was to be paid. So finally it used to be 54 rupees would be the indirect taxes that would have to be paid earlier. Presently our taxation system is like this. Indirect taxation system in India is in this way, that for the product to reach from the manufacturing stage to the final stage, that is the retail outlet, almost 54 rupees is being paid across the value chain as indirect taxes. But with the introduction of GST, you see finally the total number of taxes are to be paid only of 16 rupees. Okay, 10 rupees at one stage, 3 rupees, 2 rupees and 1 rupee. So the tax is levied only on the value addition at each stage. Here is the raw material stage, here is the manufacturer. Manufacturer has added a value of 30 rupees. So 10% of 30 rupees is only 3 rupees tax he's paying. And then retailer, okay, wholesaler is adding a value addition of rupees 20. So he's paying tax on only this rupees 20, that is 2 rupees tax. Okay, and then the retailer, he's adding a value addition of only rupees 10, so he'll pay only rupees 1 as the indirect tax. So finally the consumer is paying only rupees 16 as taxes instead of rupees 54. So 54 minus 16, you can see the profit, okay, profit that the consumer is going to have from this GST. So this is benefiting the manufacturers, the wholesalers, the retailers, the consumers, as well as Indian economy as a whole. So once the products are available at an affordable price, the demand for goods and services will increase. Okay, in India, as you know, when the products are available, for example, these gearboxes are available at an affordable price, more people will be planning to purchase them. See, people will be, in simple terms, people will try to buy lesser amount products, that is less costly products in bulk. When the product is costly, people might not buy them, okay, they might back out. But as the products are available cheaply, people will consume more, they will buy more products. So when there is more products, the manufacturing also will be more, so there will be more production. So when there is more production, as you know, in economy the output will be more. When the output is more, the GDP, the economic production and output also of the economy will increase, because there is demand for the products, and this will lead to economic growth rate, higher GDP growth rate in India. Okay, that is one of the major benefits of GST, and this is the basic concept of GST. I have tried to make it very simple for you. So after this lecture, again go through this material, then you will understand in a better way. Okay, so that is how GST is going to help. This is the basic understanding of goods and services tax that you must have.